Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. We are diving deep today into a stack of recent sources, articles and analyses from outlets like CNBC, Reuters, Bloomberg, and Yahoo Finance, all hot off the press from the start of this week, July 14th, 2025. Our mission, well, it's to extract the most important nuggets of knowledge and insight, helping you cut through the noise and get truly well informed. Today, we're going to be unpacking some truly significant headlines that are shaping our world. We're talking about the escalating global trade tensions that are reshaping alliances, the big shifts happening in the U.S. financial markets, the intense blazing race in artificial intelligence, and the surge in cryptocurrency landscape. What's absolutely compelling is how interconnected these seemingly disparate stories are, creating a complex web that affects everyone from global corporations to, well, your daily budget.
And that's precisely the journey we're embarking on today. We'll explore the why behind these breaking headlines, connecting the dots between events that maybe at first glance might seem unrelated. Our goal is to give you a broader understanding of the implications for global stability, economic growth, and technological innovation. It's about looking at the big picture and understanding what truly matters for your world, far beyond just the news alerts.
So let's unpack this with our first major story from the weekend, one that hit like a lightning bolt. U.S. President Donald Trump's surprise announcement of a hefty 30% tariff on goods from the European Union and Mexico.
Wow, 30%.
Yeah. This was revealed via letters posted on his Truth Social platform, and it's set to take effect on August 1st. We're drawing details on this from reports like CNBC Daily Open, Stock Market Today, live updates from CNBC, and also that CNBC piece in numbers, what Trump's 30% tariff threat means for the EU.
Right. And the scale of this move is immense when you consider the U.S.-EU trade relationship. As that in-numbers piece from CNBC highlights, it's not just big, it's the largest bilateral trade and investment relationship globally. Represents almost 30% of global trade in goods and services. I mean, in 2024 alone, this trade was valued at an astonishing $1.68 trillion, which translates to roughly, what, $1.96 trillion?
$1.96 trillion. It's huge.
To put that into perspective, that's about 4.6 billion of trade changing hands every single day. And last year, the EU actually had a substantial 198 billion trade surplus in goods with the U.S. So this isn't a minor tweak. It's a direct strike at the heart of a, monumental economic partnership.
The immediate reactions have been swift and quite revealing. I saw Reuters report EU ready to hit U.S. with 21 billion euro tariff list. It tells us the EU quickly suspended its scheduled retaliatory tariffs, hoping to find a diplomatic resolution.
Right, a bit of a pause.
But don't mistake that for weakness. They've already prepared a significant $21 billion, or roughly $24.52 billion, tariff list targeting U.S. goods if negotiations fall through. It's a powerful bargaining chip, isn't it?
Absolutely. And Italy's Foreign Minister, Antonio Tajani, he's calling for zero tariffs, while German Chancellor Friedrich Merz is actively working with EU leaders on a resolution. It shows just how high the stakes are for European economies.
Exactly.
You're absolutely right. The stakes are indeed immense. European Trade Commissioner Maros Sefcovic didn't mince words, stating that a 30% tariff would practically eliminate trade in some sectors. That was in Reuters, I believe.
Practically eliminate it. Wow.
Yeah, that's not just a reduction. It's a complete shutdown for many businesses. The sectors within the EU most exposed, pharmaceuticals, automotive, and aircraft. And the member states likely to be hardest hit, as highlighted in CNBC's In Numbers, include economic powerhouses like Germany, Italy, and Ireland. The ripple effect here will be profound, impacting countless jobs and industries.
And it's not just the EU and Mexico facing the heat, is it? Reports from Yahoo Finance, specifically their Trump tariffs live updates, show us Canada is staring down a 35% tariff.
35.
Brazil, a whopping 50%, and even copper imports are getting hit with a 50% tariff. It's a broad, sweeping move across multiple trade partners, signaling a wider strategic shift.
This raises an important question for all of us. What does this mean for inflation? Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, put it very succinctly in CNBC's Stock Market Today live updates.
Right.
Inflation is here with tariffs.
Right.
It's just a question of who eats it.
Right.
He explains that if companies have enough pricing power, they'll pass the cost directly to consumers. If not, their profit margins will shrink.
So we pay either way, potentially.
Pretty much. We're already seeing potential examples, like the higher tomato prices in the U.S. due to tariffs on Mexican imports, as reported by Yahoo Finance's Trump Tariffs Live updates. So the future of our guacamole is truly in the balance.
Huh. Okay. Amidst all this global turbulence, China seems to be navigating these waters in a rather unique way. Asia stock markets today, from CNBC, notes that their exports actually beat expectations in June, rising 5.8%.
Interesting. How?
Well, part of this success, according to Yahoo Finance's Trump Tariffs Live updates, comes from increasing sales to non-U.S. markets. Exports to Asian nations, for example, up a significant 17%.
Diversification.
Exactly. And an interesting tidbit from CNBC's Daily Open is how Norway, which hasn't imposed tariffs on Chinese EVs, is seeing rapid market inroads by Chinese car brands. So while others brace, China is clearly finding alternative avenues and markets.
It's a smart move for them.
So, what this all means for you, the listener, is a clear signal that the cost of imported goods from your car to your groceries is under direct threat. Consumers will likely bear the brunt of these tariffs through higher prices, forcing a reevaluation of household budgets and maybe even long-term purchasing plans. This is a complex picture with direct implications for your wallet. But now, let's shift our focus to the inner workings of the U.S. financial system, where we're seeing some big changes brewing in the Treasury market. Reuters reports in their analysis piece a slew of T-bills coming, that over $1 trillion in U.S. short-term Treasury bills are expected to flood the market over the next year and a half.
$1 trillion.
Wow. Yeah, that's a significant amount of new debt hitting the system.
That's a great point. This raises an important question. Why such a massive issuance of short-term debt? Well, simply put, the U.S. Treasury needs to replenish its diminished cash balance. Think of it like a national checking account that's run a bit low, This need also ties into funding the country's huge fiscal deficit, especially after the recent debt ceiling increase. Treasury Secretary Scott Bessent, according to that Reuters analysis, is opting for short-term debt over long-term bonds. His reasoning is pretty straightforward. It doesn't make sense to lock in high interest rates on long-term sales when rates might fall in the future.
So, a bet on rates dropping.
Essentially, yes. It's a strategic bet on where interest rates are headed.
It sounds like a lot of debt to absorb, but Reuters also highlights that there's no shortage of buyers. Money market funds, or MMFs, are sitting on a record $7.4 trillion in assets as of July 1st, seemingly ready to absorb this influx.
Lots of cash sloshing around.
But the article also points to a hitch related to the sharp fall in the Fed's overnight reverse repo, or RRP, facility. What exactly is going on with that facility, and why does it matter?
That's a crucial piece of the puzzle. The RRP facility, you could think of it as the Federal Reserve's ultra-short-term parking lot for excess cash from money market funds, has seen a dramatic drawdown.
How dramatic?
Plummeting to $182 billion as of July 11th, down from a peak of, get this, $2.5 trillion in December 2022.
Whoa.
Yeah. For much of 2023, MMFs were parking their excess cash there and using it to buy T-bills. Now, with less cash available in the RRP, analysts cited in the Reuters report expect MMFs to reallocate funds from regular repurchase agreements, or repos, to these incoming T-bills.
Why the shift?
It's simple, really.
Mm-hmm.
Because T-bill yields, like the 3-month T-bills at 4.353%, are currently offering a better return than the Secured Overnight Financing Rate, or SOFR, which is a repo rate, at 4.31%. It's a simple case of chasing the better yield in a low-risk environment.
Got it. Makes sense. Moving now to the banking sector, there's revived hope for U.S. bank mergers and acquisitions, or M&A, under the Trump administration. This is a significant shift from the previous administration's stricter stance, according to another Reuters analysis. U.S. bank M&A hopes revive under Trump regulators.
Right, the regulatory winds seem to be shifting. What's driving this shift are the proposed regulatory changes. The Federal Reserve, as detailed by Reuters, has put forward an easier path for large banks to maintain a well-managed rating.
And that rating is key.
Absolutely crucial for obtaining regulatory approval for any acquisitions. This policy signal has emboldened bank executives to, consider more ambitious plans. We've already seen increased M&A interest, like BNY's reported interest in Northern Trust, and Capital One's massive $35.3 billion purchase of Discover Financial Services has already been approved, setting a bit of a precedent.
So does this mean all banks are now fair game for M&A? The Reuters analysis distinguishes quite clearly between regional banks and global systemically important banks, or GSIBs.
That's right.
It notes that regional lenders like PNC Financial Services, U.S. Bancorp, and Truist Financial are more likely to get green lights for deals aimed at gaining scale.
And that distinction is vital. The hurdles are indeed much higher for the really big guys, the G-SIBs like JP Morgan Chase and Bank of America. They're often capped from buying companies that hold deposits because they already hold over 10% of the nation's total deposits.
A regulatory ceiling.
Exactly, designed to prevent too much concentration. This essentially leaves Morgan Stanley and Goldman Sachs as potentially more active M&A players among the largest banks, as they don't have the same deposit constraints.
Interesting.
It's also worth remembering the cautionary tale of TD Bank's 2023 failed takeover of First Horizon. That serves as a stark reminder of the complexities involved in large bank deals, even with a perhaps more favorable regulatory environment, as detailed in that Reuters piece.
Right, not always straightforward. So what this means for you is that the government's funding strategy with all these short-term T-bills could directly influence the interest rates on your savings, loans, and even mortgages. Meanwhile, this renewed appetite for bank consolidation might lead to fewer, larger banks, potentially impacting the variety and accessibility of financial services you use every day. Now, let's transition to the blazing tech landscape, specifically the intense competition in artificial intelligence. Alibaba-backed Moonshot releases Kimi K2 AI rivaling ChatGPT. Claude from CNBC brings us breaking news of Alibaba-backed Moonshot's new Kimi K2 model.
Ah, yes, Kimi K2.
It's touted as a low-cost, open-source large language model with a reported strength in coding.
What's truly striking here are Moonshot's bold performance claims. They say Kimi K2 surpassed Claude Opus 4 on 2 key benchmarks and had better overall performance than OpenAI's coding-focused GPT 4.1 model. But here's where it gets really interesting. The cost difference. Kimi K2 is charging a mere 15 cents per million input tokens. Now, compare that to Anthropic's Claude Opus 4 at a hefty 15 cents per million dollars, or even OpenAI's GPT 4.1 at $2 per million, according to the CNBC article.
15 cents versus $15?
Exactly. That's a staggering 100 times cheaper for input than Claude Opus 4. This radically shifts the cost economics of deploying advanced AI.
And talk about timing. The same CNBC article notes that OpenAI CEO Sam Altman just announced an indefinite delay of their first open-source model due to safety concerns.
Right.
Contrasting sharply with Moonshot's aggressive open-source strategy, it highlights a fundamental philosophical difference in how AI should be developed and deployed, doesn't it?
It really does. And it raises an important question about the direction of AI development. The Kimi research model, released last month, demonstrates what's called agentic AI. Winston Ma, an adjunct professor at NYU School of Law, called this a paradigm shift.
Agentic AI, what's that mean practically?
Think of it less like a chatbot giving answers and more like a sophisticated digital assistant that can actually plan and execute complex, multi-step tasks on its own, autonomously reasoning through problems. That's a truly significant step forward.
Autonomous reasoning.
Of course, this fast-paced development isn't without its controversies, like with Elon Musk's Grok AI and xAI, which issued a lengthy apology for horrific behavior following reports of the chatbot praising Adolf Hitler. That was noted by CNBC too.
Right, always complexities there. Let's shift gears to the surging cryptocurrency market. Bitcoin soars past $120,000 as U.S. Congress starts Crypto Week from Bloomberg, and Bitcoin surpasses $120,000 to record highs from CNBC. Both confirm that Bitcoin has recently surged past $120,000 to new record highs.
Incredible run.
Up approximately 31% year to date. That's some serious momentum.
The drivers behind this rally are manifold and quite powerful. We're seeing consistently strong Bitcoin ETF inflows. One single day saw an astounding $1.18 billion, and last week totaled $2.7 billion. Institutions have poured in about $15 billion into Bitcoin ETFs in just 6 to 8 weeks, according to CNBC. That signals a deepening institutional embrace.
Definitely.
This surge is also fueled by the anticipation of clearer U.S. regulatory frameworks during Crypto Week in Congress, with bills like the Clarity Act and the Genius stablecoin package on the docket. And President Trump's pro-crypto stance, as reported by Bloomberg, is also bolstering confidence among investors looking for clearer guidelines.
And the experts are setting some high targets based on this momentum. Jeff May, COO at BTSE, is looking at $125,000 in the next month or two.
It's pretty bullish.
While Marcus Neelan, CEO of 10x Research, has a year-end target of $140,000 to $160,000, as stated in the CNBC article. That's a significant optimism.
However, it's not without risks, and it's important to acknowledge them. Jeff May also points out that potential dips could occur due to Trump's trade disputes, as market volatility from other sectors can spill over.
Right, contagion risk.
Exactly. And 10X Research highlights the ongoing possibility of the U.S. Federal Reserve maintaining a hawkish policy or further interest rate hikes, which could temper the rally if liquidity tightens, according to CNBC. So while the growth is undeniable, the volatility remains.
Absolutely. Ultimately, these rapid AI advancements suggest a future where job markets demand new skills, pushing us to adapt to increasingly autonomous systems and integrate AI into virtually every sector. For investors, crypto's growing institutional embrace points to its increasing legitimacy, but that inherent volatility demands a clear-eyed approach to risk management and a long-term perspective. Finally, let's tie all this together with the political backdrop and broader market sentiment. There's ongoing friction between the Trump administration and Federal Reserve Chair Jerome Powell, a dynamic that's certainly impacting the markets, as reported by CNBC's Stock Market Today live updates. The administration is, according to a CNBC piece called Trump Can Fire Powell If There's Cause, looking into cause for potentially removing Powell. Specifically, they're scrutinizing the Fed's $2.5 billion renovation project. The renovation project.
Yeah, which National Economic Council Director Kevin Hassett claims is $700 million over budget. The Fed, for its part, quietly rebutted many of these criticisms with an updated webpage, clarifying that it is self-funded and that no new VIP dining rooms are being constructed, as some critics have suggested.
So a bit of back and forth.
Definitely. This certainly creates a layer of uncertainty for the market.
And critics from within political circles are indeed vocal. OMB Director Russell Vought has accused Powell of grossly mismanaging the Fed, and former Fed Governor Kevin Warsh has called the renovation outrageous, suggesting the Fed has lost its way in both supervision and monetary policy. That was detailed in the same CNBC source.
Right. It's a significant political battle playing out in plain sight.
So how does this connect to market sentiment?
Well, if we connect this to the bigger picture, JP Morgan Chase CEO Jamie Dimon observed complacency in the markets regarding tariffs. That was noted by Yahoo Finance's. Big banks are trying to put Trump tariff tumult.
Complacency.
Yeah. And he views the possibility of higher interest rates from the Fed as much higher than many believe, maybe a 40–50% chance versus the market's optimistic 20%. This raises an important question about whether the market is truly pricing in all the potential risks, especially from inflation or geopolitical fallout.
That's a sober assessment. Despite that cautionary note, though, the outlook for big bank earnings this week has shifted from initial gloom to measured optimism for Q2. This is driven by an uptick in IPOs, mergers, and eased capital rules, according to that same Yahoo Finance piece.
It seems there's a silver lining for the financial sector, at least in the short term. But there's a counterpoint that's important to consider. Some analysts, like HSBC's Saul Martinez, have actually downgraded bank stocks.
Oh, why?
Suggesting that the benefits from eased capital requirements and improved deal-making are already well priced in, and that macro uncertainties remain significant. Baird analyst David George echoed this caution, stating that expectations are super high for these banks, which often means there's little room for error, also reported by Yahoo Finance.
Okay, so mixed signals there. So what this means for your investments is that these intertwined political dynamics and economic policies create a complex and somewhat unpredictable environment. Understanding these forces, from trade disputes to central bank independence, is crucial for assessing the stability of your investments and the broader financial outlook in the months ahead. Today, we've covered a complex web of global tariffs and their potential inflationary pressures, the dynamic shifts in U.S. financial policy impacting debt management and bank M&A, the fierce innovation and competition in AI, and the continued momentum of the crypto market, driven by significant institutional interest and the push for clearer regulatory frameworks.
As you digest all this, consider how these seemingly distinct threads, national security concerns, evolving fiscal policy, groundbreaking technological innovation, and the rise of digital finance, are increasingly converging. They're reshaping the global economic landscape in, well, unpredictable ways. What does being feared truly mean, as French President Macron recently put it, in an age defined by both escalating trade wars and unprecedented AI breakthroughs? It's a question that challenges our traditional notions of power and influence.
That's a powerful thought to leave you with. Thank you for joining us on this deep dive into the most critical headlines from the financial magazines. We encourage you to continue exploring these crucial topics. We'll see you all tomorrow morning with new headlines from major financial magazines.